the markets this morning. Equities up again, and this is happening as yields are coming down around the globe. What's the message? That sounds like it's bigger than just a thought that maybe the U.S. Federal Reserve is pivoting.
Ultimately, I think it's going to take something like some bad economic data, a plunge in the market, or something to stop this rise in yields. Because it's been extraordinary. Like I said, it was actually July 29th is the last week that we saw yields fall from Monday through Friday.
Treasury bonds have become the new bride of Wall Street investors. Everyone is hedging Treasury bonds, because despite the low yield, Treasuries have been a better investment than the stock market. Lyn Alden, a world-renowned economic commentator and astute investor, talks about why she's not excited about bonds. Do you know what else is exciting? We have something big coming up soon. Subscribe and turn on the notification bell now, so you don't miss out. Coming soon.
Even after this crazy sell-off, those yields are still below at least current inflation. Now they're above forward inflation expectations, but forward inflation expectations has not been particularly accurate in recent years. And so I think it's a combination of, one, trying to deal with the inflation, and two, some of it's mechanical. Some of it is, as central banks are trying to fight that inflation, they're trying to not buy as many bonds or even let some bonds mature off their balance sheet. And so now you have basically oversupply of bonds, large deficits, and then you have some of the biggest buyers not buying. And then when you go to some markets, like for example, the U.S. Treasury market, foreign countries use those treasuries as like a ballast for their own currencies. So when the dollar is weak, they're generally accumulating treasuries, and when the dollar is very, very strong, like it is now, especially compared to many other developed market currencies. So ironically, some of the emerging markets are actually holding up better, but the dollar is very strong relative to a lot of these other currencies. And so what they do is, first they stop buying treasuries. And then two, they can start letting treasuries mature off their balance sheet. They can sell some of the shorter duration stuff that they have. And, if it gets bad enough, they could even sell some of the long duration treasuries. And so you have a lack of a foreign bid for treasuries. And so basically in this environment, it's a very toxic combination for the sovereign bond market. I would say that, again, going back to 2019, I was saying that, whatever excess there is in equities, I was more concerned about the bubble that's in sovereign bonds, because when you have, for the first time ever, like negative yields, or in the United States, like record low yields, and I was at long horizon, I was seeing inflationary pressures, possible to start building. It's just a toxic combination, and it's funny. It surprised even me with how rapidly it happened, and part of that is because we got certain catalysts that they were even more rapid than we could have gotten. Like again, the energy crisis in Europe and the war in Europe.
There are suggestions that treasuries could enter into troubled waters if interest rates continue to rise. The U.S. Treasury bonds have been very volatile in the third quarter of this year. This volatility was last seen in the heat of the 2020 pandemic, when the government bought $1 trillion worth of treasuries in a bid to infuse some liquidity to the economy. Now we're experiencing the other extreme, as the government desperately tries to shrink liquidity through high interest rates. The Washington Post had recently reported that government officials are worried about the dysfunction in the bonds market, which has increased the cost of the federal government's borrowings. Janet Yellen, the U.S. Treasury Secretary, has come out to allay fears, saying it is critical the bonds market continues to function properly. The problem with bonds is, the government is using this to borrow money from the public with the promise of paying back with an interest, depending on the duration of the bonds. Bonds that have already been issued were issued at lower interest rates than bonds are now being offered. This could cause a saturation of low-yielding bonds that few buyers are willing to take up, as it is unfavorable to those who buy when there is still the possibility of interest rates going up. Despite the concerns of buying bonds at a low interest rate, the U.S. Treasury bills are still more in demand than any other asset class. Last week, the Series 1 savings bond made headlines as it was being offered at 9.6% interest rate, a rate too good to be overlooked. Purchase was available for only a day, after which the interest rate was dropped to about 6%. The frenzy that ensued as everyone tried to purchase this bond led to the U.S. Treasury's website crashing. When bonds are this attractive, it is a sign that the stock market is in trouble.
So we've been in a declining PMI environment, so economic decelerating environment since 2021, since towards the end of the year. And so either way you look at it, we're in a declining, a decelerating economy. And we had 2 quarters of negative real growth. Third quarter is looking positive. But I think the general trend is still negative, especially because the things I said before, like these existing high rates, let alone if they go higher, but the existing high rates, more and more debt's going to start refinancing those higher rates and put pressure on corporations and different types of consumers. We're seeing kind of weakness in auto lending, default rates. We're seeing still, I think PMIs are still kind of headed down longer term, and there are things that could change my mind. Like if you were to have some sort of big pivot and a weak dollar, that's a type of stimulus, right? So that gives you some frontier market boom. That gives you, kind of an uptick in corporate profitability. You can kind of arrest that decline and maybe get another acceleration out of it. But it seems like if that's not the path they're going to go on, then I do think that quarter by quarter, I think unless there's a trend change, I think we are marching towards recession. Yes.
Lyn Alden is concerned about the U.S. PMI that has continued to decline. PMI, which is the Purchasing Managers' Index, is one of the most important indexes used in predicting a recession. It measures the productivity of the nation in the manufacturing industry and services sector too. When productivity is low, GDP would also be low, and the economy would be constrictive. There are new concerns as the PMI drops to 49.9 against the 51.2 points that was earlier expected. This has pulled on the dollar too, causing it to fall below 112 points on the DYX index. On the other hand, the services PMI had also dropped by a wider margin than that of manufacturing. It slid down to 46.6 from 49.3. The composite PMI now stands at 47.3 from its prior position of 49.3. Demand for goods were low in October, so we can be certain that the next PMI report would slump further.
So you can get a bid in some of these harder assets that don't have margins, kind of the gold Bitcoin spread compared to something like corporations that even if there's a Fed pause or pivot, they might still have deteriorating corporate earning situations. So stocks might run into issues, right? So there are different kind of things to look out for like that. I generally think that as long as we're in this economic decelerating environment, generally stay defensive. For me, it's been less about bonds and it's been more about things like healthcare stocks, energy pipelines, tobacco company, kind of consumer staple type of things. And I've overweighted that. So I don't do like a fast turnover portfolio where I go all into just these things, but I've been kind of tilting to that direction since the beginning of this year, while still having a barbell approach of some risk assets that I like. Some of them were worked out, some of them didn't. So, for example, Brazil has been one that I've been overweight Brazil. That one's done quite well. Whereas, for example, I also have a Bitcoin allocation that is, it's been holding up recently pretty well, but obviously earlier this year that's done quite poorly. And so I've been balancing kind of a risk-off, defensive, higher yielding type of portfolio with some degree of inflation protection built in, and then kind of select risk assets. I like India, I like Brazil. Long term, I like Bitcoin, but I have been, I keep reminding people that generally in a declining PMI environment, it generally runs into headwinds.
Lyn Alden says she remains bearish on gold because its price is not volatile. It is still a stable hedge for those looking to protect the value of their funds. Lyn seems not to be alone because the third quarter of this year has seen a rise of 28% in demand for gold. This is despite gold's poor price performance. There's still a bearish sentiment on gold, but it's likely that existing holders are increasing their stakes. Year-on-year demand is also up by 18%. Not surprising, as 2021 was a good year for cryptocurrencies and the stock market. Investors would have preferred those other asset classes to gold. Investing in this channel by giving this video a thumbs up is worth a lot more than gold to us. While you're at it, subscribe to this channel for more analysis of current economic trends.